Hello, good afternoon. You've tuned into MF Corner on CNBC TV18 and I'm Vinny Motiwala. Today, what we're going to be doing is we're going to be solving all your mutual fund queries that you all have sent us through the days. And for solving those queries, we have our experts joining in with us. Today, we have Prableen Bajpai, founder at FinFix Research and Analytics, joining in with us, as well as Nasreen Mamaji, CFP founder at Moneyworks Financial Services, to solve all those fund-related doubts and queries that you all have sent us. Good afternoon, ladies. Thank you so much for joining in with us on the show as always. And let's get started quickly because we have a whole host of mutual fund queries that have come in. So we'll get started by solving these queries. Starting with the first query for today, we have Joseph, who's writing to us from New Delhi. He's saying that he has invested rupees 10,000 in Parag Parikh Mutual Fund, Canara Robeco Mutual Fund, a blue chip equity fund, and rupees 5,000 in Access Small Cap Mutual Fund, as well as an HDFC Mid Cap Opportunities Fund, HSBC Mutual Fund, as well as Motilal Oswal's S&P 500 Index Fund. Now he wants to know whether he should make any changes in his portfolio in the next 10 years. Nasreen, good afternoon, and let me take this to you first.
Sure. Thank you so much for inviting me on the show. And I'll get straight into Joseph's question. So he's done a pretty, interesting asset allocation besides the in the various categories. So I'm assuming Parag Parikh is a flexi cap fund. So he's got one flexi, one blue chip, a small cap, mid cap, value, UTI 200 momentum, which is a factor-based fund, and the Motilal Oswal S&P 500 index. So more or less okay, but I'm just suggesting that UTI momentum 200, 30 index, we may not be chasing momentum stocks in the next couple of years or the next, 3 years. He could switch to, they have an NFO coming up, which is a quant fund. So maybe he can go into that because that is also factor investing, but they will be taking more factors into play, not just the momentum, from the smart beta suite of products that he's doing. So I think that one small change that I would recommend. Otherwise, all his funds are pretty much safe to continue. The asset allocation is also very complete in, between the mid cap, small cap, flexi cap, and the large cap. And I think if he continues like this, which is quite a, good sum of 40,000 rupees SIP per month, after 10 years, you can expect a crore if we calculate at an expected CAGR of about 13%. So, this is what his expectation can be after 10%, provided we get 13% annualized return compounded every year for the next 10 years. So all the very best. And, I hope that you do well in your investment journey, Joseph.
Absolutely. And Prableen, anything you would ask the viewer to change? Because Nasreen has just made a very small change in this one. Do you think the viewer's portfolio right now, what he's doing in terms of investments, seems right?
Good afternoon, Vinny. Good afternoon, Nasreen. I think Joseph can just keep an eye on the Access Small Cap, although it's been a consistent performer, but broadly it's been sluggish on the upside capture ratio, if you look at that, and it's on rolling return basis when it's somewhere in between. So I think that's one fund I think Joseph can just keep an eye on. Otherwise, broadly the allocations are fine. Canara Robeco Blue Chip Equity, which is a large cap active fund, that has just managed to sort of match the category and the benchmark returns on a rolling return basis. So that is again one fund, I think, which is avoidable because there's already an overlap with Parag Parikh and HSBC value. So probably Canara Robeco can stay or go depending on what he wishes because it's a 10-year allocation. I don't want to make too many changes here. But if he plans to continue further, Vinny, then definitely I would suggest a passive equal-based strategy for the large cap.
Okay. Thanks for that view coming in there, Prableen. Let's move on to the next query. This one is from Lakshmi, who's writing to us from Mumbai. Now, she says that she has an SIP of rupees 66,000 for 5 years and is investing in the following funds. 16,000 is in ICICI Prudential Nifty Bank Index. 20,000 is in UTI Nifty 200 Momentum Fund. Momentum 30 Index Fund, and rupees 30,000 is in ICICI Prudential India Opportunities Fund Growth. Wants to know the outlook on her funds and whether she will be able to deliver and get good returns even from here on for a long-term period if she's looking at it. Prableen?
It's a very interesting allocation, Vinny, because it's one strategy index, it's one sectoral fund, one thematic fund. So it's a very different kind of a combination she's taken. If the same portfolio is for 10 years, I won't make too many changes. But given the time horizon, 5 years, I think it can be tricky with a sectoral fund like banking. Now, banking, given the current market situation and the way private banks have performed, maybe as a tactical call, it's not a bad idea to have some allocation. But then the ICICI India Opportunities also has a decent allocation towards banks. So out of the top 5 stocks in ICICI India Opportunities, 4 are banks. So I would say that probably out of the 66,000, maybe she can reduce her allocation to the banking index, keep it at 6,000. And then if she's still going with a 5-year view, and she has a slightly higher risk appetite, then I think that she should complement this with a multi-cap fund from probably SBI or Motilal, because they have less allocation towards banks, because ICICI India Opportunities as it is having decent allocation. Or if she's wanting to reduce the level of risk, then I think a flexi-cap fund, addition of a flexi-cap will be good. UTI momentum, again, with a long-term view looks good. But again, 5-year can be slightly tricky. So she can just trim down the allocation over there, but she can continue with it. So overall, trimming down on the 2 allocations and probably adding a multi-cap or a flexi-cap, depending on how she wants to, the level of risk that she wants to hold in a portfolio. And she can create around 54 lakhs, Vinny, in the next 5 years at a XIRR of 12%. If she continues for 10 years, then it can be almost triple, 1.51 crores.
Okay, sure. And Nisreen, your thoughts on this one as well? 5-year time period as well as 10-year time period. What should the viewer be expecting in terms of returns?
So basically, since her SIP is about 66,000, I feel that she's very concentrated in these 3 particular, themes. One is thematic, one she's got the momentum factor, and one she's got an India opportunity. So the amount is about 66. I would suggest that, she break it up into at least say about 15,000 per fund and have 5 categories. Especially since, one of her choices is to, that she needs the funds after 5 years. I would think that she can go slightly more safer. So I would definitely recommend that she goes into a flexi-cap category, say for one allocation of about 15,000 rupees and say 12,000 rupees. If you have 5 funds, the 12,000 in each, divided equally so that you get a good basket and, you're not, betting on any one particular sector. Then rather than just going for a nifty bank index, I would suggest a thematic fund of funds kind of a strategy. IQ has a thematic fund of funds where, the fund manager himself will decide the funds for the next 3 to 4 years, the themes for the next 3 to 4 years, rather than the investor herself taking a larger call of at least 16,000 rupees per SIP only on the banking index. Similar views, that she already will have some amount of banking allocation and India opportunities also. So one flexi cap, one thematic fund of fund, one say maybe like a larger mid category, because if the corpus is required after 5 years, I think larger mid would give her some amount of safety. Sure. And say one more category that we can suggest, India opportunity, she can definitely continue. And one more that we can suggest is like a business cycle fund, which will go top down approach sort of. So I would suggest maybe like a Sundaram business cycle fund. So this way, she gets a complete basket of stocks and various, categorizations also, rather than betting 66,000, the entire SIP on these 3 kind of categories that she's earlier selected. And if you look at about 13% CAGR, in about 5 years, she would expect 61 lakhs. And if she can extend the time frame to 10 years, it will be about 1.7 crores. So that would be my suggestion, to take 5 categories and divided approximately equally 12 to 13,000 each.
Okay, let's move on to the next query, and this is a caller query that we have. Santu Mundal is calling us today from West Bengal. Santu, good afternoon, and can you hear us? And please take your query.
I am Santu Mundal. I am 36 today.
Right, Santu, we can hear
Hello?
you. Yes, we can hear you, Santu. Go on.
I shall retire at 60. I am in West Bengal government service. I am entitled to government pension.
Right.
My service is like bond or debt fund. No standard deviation, no fluctuation. So my money should be in equity. If I withdraw money from PPF and General Provident Fund to put it in well-managed equity funds like HDFC FlexiCap, ICICI Value Discovery Fund, only to get better return than PPF and GPF. Have you any objection? Is it a wise decision?
Sure. Okay, sure, Santu. Prableen, what is your view on this one, given that, he's thinking that would it be a sound decision to move out, take out his money from PPF and General Provident Fund and invest maybe into equity mutual fund, something like a ICICI Value Discovery Fund is what they're looking at to, obviously retire at a good considerable age of 60. Then is that something that is advisable now?
So two parts to his question, Vinny. So number one, that should he withdraw from PPF in General Provident Fund, I would recommend that probably one of them can be, he can exit from one of them and continue with the other, because it's okay to allocate. Of course, we require equity allocations, but at the same time, probably he doesn't have too much exposure to equity. So I think suddenly moving from all your fixed income, something which is giving you tax-free sort of returns at 7.1%, I think a partial withdrawal should be done. So I think the PPF can be exited and invested in mutual funds. The mutual fund portfolio, like he mentioned, HDFC Flexi Cap and probably the Wellman, slightly initially the more large cap tilted, but he definitely requires a portfolio which is well diversified. And this portfolio which he creates should also be supplemented with SIPs. So whatever allocation was going towards PPF can be diverted towards SIPs. That point number one. But the other point is, Vinny, that the ideal way to calculate what you require and how you should be managing your money is based on your goals. Considering that this is for his retirement and he would get a pension, he should still factor in, today what is the expense and whether the pension is going to be good enough for him at the time of retirement, and look at the other goals as well, and then take a decision on the allocations. But definitely having the security of a pensionable job, the allocations towards equities must be done, but not from the whole amount, partial, and then supplemented with SIPs is what I would recommend.
Okay. And Nasreen, your view?
So somewhat similar. You can switch some of the funds from PPF to, equity mutual funds. It could be a wise decision, not the entire corpus. Because, you're looking at retirement, you're only 37, so you have quite a long tenure to look forward to. So with the long-term horizon and the safety net of the government pension, both combined, I think that the advantages of switching to equity mutual funds can be quite good. You get higher growth potential, you get inflation protection. So the PPF lock-in period is about 15 years, and then partial withdrawals are allowed after 6 years. So what I would recommend is, a gradual reallocation instead of withdrawing a lump sum. And so a smaller portion periodically can be, systematically transferred into the equity mutual funds. And then when you are retired, you can look at an SWP option, a systematic withdrawal plan, along with your government pension, so that, your own goals and your expenses can be met at that time. So keep a portion of the PPF for safety and also for the returns, and for the inflation, matching, I think that definitely equity would be a better, bet. So say 50 to 60% of your current, PPF corpus can be switched to equity mutual funds in a systematic way. So, do the reallocation in a gradual way rather than in a lump sum.
Sure.
And with ICICI Value Discovery, basically, which is your choice, it has a very good track record. It considers diversifying into a mix of large cap, mid cap, and small cap. And also it has some amount of sectoral and thematic funds. So Value Discovery of iGroup can be one of your choices. And if your risk tolerance is a little lower, then you can go for maybe a hybrid equity fund or a balanced advantage fund, because, you're moving straight from debt into equity. So I think out of the 50 to 60% that you are switching over, keep about 15% in something like a hybrid category or a balanced advantage category, so that the transition is a little smooth for you. Because if you see a lot of volatility, it might not go with your own risk tolerance. So keep in mind that do a bit of both, so that your overall portfolio will see a good return. At the same time, the volatility will not upset you, because you have to also maintain your psyche and your psychological, happiness as well.
Absolutely. But on that note, viewers, we're going to step into a very, very short break. But don't go anywhere. More queries on the other side. So we'll be back with that. Welcome back to MF Corner on CNBC TV18, where we are solving all your mutual fund related queries today with Prableen as well as Nisreen. Let's keep it going, and this query now is a caller query again. We have Rajesh who's calling to us from Mumbai. Rajesh, good afternoon. Can you hear us? And please take your query.
Yeah, hi, good afternoon. I've been actually active on equity for since COVID actually. Invested a couple of crores and it's grown well. Now I have some lump sum amount coming through some property sale and all. I want to know, should I get into mutual funds? If I get into mutual funds, my question is, should I invest in one go, or can I do staggered, period of time instead of doing SIP? Maybe in 6 months or 3 months time frame, about 25 to 50 lakhs of investment. What is the best option? Should I do one time, or should I do staggered, because the market is correcting, we don't know what is the low point?
Yes, Rajesh, okay, we got your query. We'll take it to Nisreen first. Nisreen, what should Rajesh be doing? Staggered manner investing, or just the lump sum amount that he's getting between 25 to 50 lakhs? Then should that be invested immediately at a whole, or staggered manner to investing?
Yeah, so what I would recommend is that you invest it immediately into, say, a money market fund, a low duration fund, or an arbitrage fund with a nil exit role. And then you systematically transfer this over the next 3 to 4 months into the target funds, because that will be a form of staggering. So that for immediate purposes, you're not getting only savings bank interest, but you're getting a little more, especially if you're in an arbitrage fund, where you can expect between 6 to 7% annualized at today's spreads. So this what will happen is basically you don't have the risk of timing the market, because if you were to invest it lump sum into the market, then obviously you would have the market timing risk. This way you will have a disciplined approach. Your money will be fully invested, and the STPs would kind of give you some amount of discipline of getting into your target funds over a period of time. So you can take anything between say 12 weeks to 16 weeks, that is between 3 to 4 months. You will be fully invested into your target funds. Now, when you're making the corpus for the 25 lakh, keep in mind your time frame that you're investing for, as well as your own risk tolerance. And also keep in mind that you might need liquidity in the shorter term. Thereby, you must keep some amount, say in an equity savings or in a balanced advantage kind of a fund, so that if you need money in the shorter term, that will be available to you, in terms of liquidity. And say 70 to 80% of the corpus, you can, invest it in multi-cap funds, certain thematic funds, and, make your basket of investments in that way. Even small and mid-cap have a certain allocation towards that as well, if your time frame is anything above 7 to 10 years. So this is how you can make a complete allocation, go through the staggered approach, and your returns in a systematic transfer plan that we call an STP from the source fund to the target fund. We've done statistical testing, and it's always better than investing in a lump sum, because you might be expecting corrections in the next 3 to 4 months. Thereby, you will get the advantage of that. It's like buying in a sale. You will get more units at a lower NAV in case there is a correction. So definitely do that. Do the staggered approach. It's called systematic transfer plan. But be fully invested now, and don't leave your money in the savings account at lower rates of return.
Okay. And probably in your view?
Broadly the same, Vinny. I would also suggest a staggered approach, but I think the percentage allocation that he wants to take would depend on his time horizon. So assuming that it's a long-term portfolio, which is beyond, let's say, 7 years, he should have the mid-cap and the small cap as well as large cap. So if I'm taking a large cap index, a mid-cap and a small cap, let's say active fund structure, which I'm giving, then in the large caps, I would say that probably 30-35% can be put in right away. Remaining would be via staggered approach from a liquid or an arbitrage fund going into the large cap. In the mid and the small cap fund, it would be, let's say, 10-15% allocation right away, and remaining would be staggered over the next 4 to 5 months. So yes, the STP route will be better to allocate.
Okay. Prableen, just the next query we have is coming in from Sahil, who is writing to us from Delhi, wants to know top 3 mutual funds to start investing in for the long term.
Always difficult to answer such questions. Vinny, top 3 funds, we all want to stay invested in the best performing funds. And I think calendar year wise, if we see within the same category, there is hardly any year when the same scheme is actually able to give you returns or is stopping, let's say within the small caps or the mid caps. So if he's new to investing and being in the top funds is already on his mind, I would suggest, Sahil, that, rankings are not permanent. So it's better not to look and invest what has happened in the past. I would say create your core with 2 passive funds, a large cap index fund and a mid cap index fund, and complement it with probably 1 multi-cap fund to begin with. Later, you can add a small cap fund. And I think at least with index funds, then you don't have to worry about being in the best performer and not. And that also creates a good, solid core for you. And within the active funds, the multi-cap and the small cap, if you're adding those, I would say a slightly more value-centric AMCs would be better, so that passive investing, which is slightly more growth-oriented, can be complemented better.
Okay, Nisreen, this next query is written by Akshay Joshi. He wants to know whether the existing SIP in small and mid-cap fund should actually be now shifted to large-cap funds, given in the view of valuation that we are looking at. What is your view?
So typically, when you're making a strategy, when you start a financial plan, you're doing it, say, for the next 5 to 10 years. So I don't recommend that, every time that you make these kind of tactical changes, unless you have, selected the worst performing fund over at least 8 to 10, quartiles. If that happens, then yes, you have to make the tactical decision. But strategically, if you've made a plan and you've done an entire basket of investments and a certain, allocation towards mid caps, small caps, large and mid, maybe balance advantage, equity savings, I think more or less you should kind of stick to that plan depending on your term of investing and also your goals, because you will be having some short-term goals, some medium-term goals, and some long-term goals. So your entire financial plan will be based on these goals, right? So every time, because these things keep on changing. Right now, if we are looking at, say, the last 3 years, people followed a value strategy. The next 3 years, we're looking at kind of an alpha momentum strategy. Also, a combined strategy is what we think is going to work, quality and alpha. So these things will keep on changing over every 3-year cycle. But if you have your strategy in place, I think that it's better for you to stick to the strategy and make tactical changes based on your annual reviews or 3-yearly reviews on the entire portfolio, rather than being reactive and taking a stance like that. Okay? So now the mid and smalls at this point, you might find that expensive at this point. But if you're investing in a SIP over a period of time, I think you should stick to that strategy, because those are probably meant for your longer term goals, like, maybe retirement, children's education, wealth creation, in the longer term, big asset purchase, etc. Right. So don't react, to any sudden changes in the market. Stick to the long term planning and definitely review the portfolio every couple of years to make sure that you are on track for the entire portfolio as a whole.
Absolutely. Okay, that was the last query. Actually, we had a whole host of queries still left to go. But Nisreen as well as Prabreen, thank you so much, for joining in with us and solving these important doubts on mutual funds and, how they should be looking at their portfolios. Thank you so much for that. But that's all the time we have on this edition of MF Corner on CNBC TV18. Don't go anywhere. Closing bell is up next to take you through the last hour of trade.